We built on the foundation of price patterns with our rectangle case study. So now we can take a closer look at the other types of formations that technicians have identified over the years. I'm going to start with the head and shoulders, which is probably the most notorious of all the various price patterns.
Let's start off by considering the head and shoulders top. A head and shoulders top can be defined as the final peak, that's the head, separated by two smaller ones, and those are the shoulders. This diagram initially shows a rally, and although we don't know it now, it will turn out to be the left shoulder. Then another rally takes the price to a new high. That's going to be the head. Finally, the price declines to a level similar to the previous bottom and experiences another small advance. The following decline also appears to halt at the same level. Now we can construct a trend line joining the lows. This is called the neckline. And when, and only when it's been violated, can we say that the pattern has been completed. Note that at that point the series of rising peaks and troughs that preceded the formation of the head has been reversed, as this peak is lower than this one, and when the price breaks the neckline, it falls below the two previous troughs. Finally, we see a retracement move. If these rallies and reactions were of intermediate term proportion, the first shoulder will be the penultimate advance in the bull market, and the second the first bear market rally. The head would, of course, represent the final intermediate rally in the bull market. Volume characteristics are important in assessing the validity of these formations. Activity is normally heaviest during the development of the left shoulder, and tends to be quite heavy as prices approach the peak. The real tip-off that the head and shoulders pattern is developing comes with the formation of the right shoulder, which is invariably accompanied by distinctly lower volume than the head or the left shoulder. Ideally, the level of volume contracts as the right shoulder rally unfolds. You can also see another volume principle at work, in the sense that these dashed red arrows indicate that volume leads price, as the volume on the head, while heavy, is relatively lower than that on the right shoulder. So we see the price rise and fall, and volume fall on the rally, and expand on the decline, in a classic bearish manner that we saw in the basic building block module. In many marketplace examples, you see that the volume characteristics differ from those described here, and the pattern still works. Thus the volume patterns are set as a guide. If they're present, the formation is more likely to work. Just because they're not, doesn't mean that the pattern should be ignored. Alternatively, if you can spot the price and volume action that are reminiscent of a head and shoulders top, this can be used as a guide in order to anticipate the final completion of the pattern. The measuring formula for this price formation is the maximum depth of the pattern, which in the case of the head and shoulders means the distance between the top of the head and the neckline. This objective is then projected downwards from the neckline at the breakdown point. It follows that the deeper the pattern, the greater its bearish significance once it's been completed. Sometimes a head and shoulders completion will be followed by a fairly extensive downtrend. At others, the negative effect of the pattern will be quickly cancelled by the completion of a base. This means that you should not assume that all breakdowns lead to large profits. Always keep an open mind as the technical condition changes. Head and shoulders patterns come in many different varieties. The ones I've shown you so far had horizontal necklines, but there are many other varieties, all of which possess the same bearish implications as a horizontal variety once they've been completed. When the neckline of a horizontal pattern has been violated, a series of declining peaks and troughs is signaled. Not so with the upward sloping varieties shown in this diagram, because at the time of the breakout, the price is still above its previous low. Note that the measuring implications are identical, where we take the maximum depth of the formation and project it down from the breakout point. On the other hand, this is a downward sloping formation with its measuring implication. For this pattern, the declining peaks and troughs have been reversed prior to the violation of the neckline. Here we see a nice downward sloping head and shoulders for Alcoa, just before the 2008 financial collapse. Note that the downside objective was achieved many times over. I'd like to add that if you see a lot of head and shoulders patterns developing in many different charts, there's a good chance that you're witnessing a prelude to a general market decline. Most probably not as severe as 2008, but a decline nonetheless. In terms of pure price objective, the downward sloping formations for any given depth are more bearish than their horizontal upward sloping associates. And that's because the breakdown from the neckline takes place at the lowest point of the pattern. By the same token, we must be careful because a neckline with an extremely sharp angle of descent is more likely to be followed by a false break. This is an extension of the rule relating to the steepness of the angle of ascent or descent for trend lines that we discussed in a previous session on basic building blocks. After all, a neckline is nothing more than a special trend line. Occasionally, the battle between buyers and sellers is exceptionally complicated. This leads to the formation of what we call complex head and shoulders, in which there could be one or more right or left shoulders. This chart shows a more complex formation, because the pattern consists of more than a head and two shoulders, as flagged by these red letters. You can see here that the left shoulder is a head and shoulders in its own right. So too is the right shoulder. I think there's 2 points to emphasize here. First, that the complex and upward and downward sloping varieties all have one thing in common: the final rally separated by two smaller rallies, followed by a break below the neckline that actually joins the bottoms. Second, the measuring implications are the same. Finally, it's important to understand that the complex variety can come in many different varieties, but just remember they all represent transitional points where buyers and sellers are evenly matched. The more shoulders and heads that are formed during the course of the pattern, the bigger the battle, and therefore the greater the implication from its completion. Head and shoulders can take on many different characteristics. Since the breakdown point is the critical one, the nature of the right shoulder deserves some additional attention. After all, this is the trap door through which prices will drop. This diagram shows three possibilities that indicate a particularly interesting battle between buyers and sellers. This one displays what I call a right shoulder shakeout. These develop when it looks as if the shoulder is developing in a fairly controlled way. Then the price falsely breaks above the resistance in the form of a previous trend line or high. This whipsaw action is unnerving for bull and bear alike. As a result, this unwanted volatility results in an unusually nasty decline. This one also portrays a substantial amount of instability, which again leads to a sharp price decline. The problem with this type of wide-ranging trading action is that the breakdown is followed by additional choppy action. Thus, while the ultimate profit achievement from taking a short position is usually well rewarded, the roller coaster ride to get there can often be extremely nerve-wracking. Finally, this example offers a much more controlled right shoulder. In this instance, the price forms a triangle. For those of you who are not familiar with these patterns, I'll be covering them later. For now, though, just observe the two converging trend lines. This offers the best of both worlds. On the one hand, you can see that rallies are getting progressively weaker. Second, the upper trend line offers a declining level of resistance, and therefore a great benchmark against which to sell or go short. So if you did so, you place your stop slightly above the line. Also, the converging nature of the lines indicates a fine balance between buyers and sellers. If resolved in favor of the sellers, the bearish overtones of the whole formation indicate a potentially sharp decline. Here's an example showing a head and shoulders for a 5-minute bar chart for Caterpillar. Note the right shoulder shakeout above this line, forming the right shoulder. Not surprisingly, all those who bought on the upside break were forced to sell when it didn't hold. And as typical of whipsaws, it was followed by an above-average move in the opposite direction to the whipsaw. Note also that the right shoulder was a downward-sloping head and shoulders in its own right. Finally, the head and shoulders can also form as a consolidation formation, as you can see here. Measuring and volume characteristics are the same as with the reversal type. The only difference that I've noted is that since by definition a continuation pattern forms during an ongoing trend, it already has some upside momentum built into it if it's a continuation during an uptrend. The reversal pattern is really reversing downside to upside momentum, kind of like a car starting from 0 miles per hour. That means that breakouts from continuation head and shoulders are often far more dynamic. Here's an example of a continuation head and shoulders during this downtrend. You can see that once completed, the price of Alcatel moves down pretty sharply. Another smaller consolidation head and shoulders forms later on in the year. It too is followed by an above average decline. Head and shoulders patterns also form at market bottoms. This is usually called an inverse head and shoulders or a reverse head and shoulders or even a head and shoulders bottom. It consists of a final decline separated by two smaller ones. These formations also come in the upward and downward sloping variety, as well as the complex variations. So this decline, the lowest one, becomes the head, and the two lesser declines, the left and right shoulders. The peaks of the two rallies are connected to form a neckline. When the breakout develops, you can appreciate that the series of declining peaks and troughs that ended with the formation of the head is reversed. Normally, volume is relatively high at the bottom of the left shoulder and during the formation of the head. But the key volume characteristic is activity on the right shoulder, which should contract during the decline and expand substantially on the breakout. Many patterns are not accompanied by higher volume on the breakout, yet the move still appears to be a valid one. The rule should be, if volume expands significantly, it adds strength to the signal. Only if volume contracts on the breakout rally should you treat it with suspicion. Here's an example where the breakout takes place as volume shrinks. There's absolutely no indication of buyer enthusiasm here. These arrows indicate declining activity on the breakout and expanding volume with motivated sellers on the decline. A classic message for disaster, as the breakout turns out to be a false one. This diagram demonstrates the measuring objective, which is, of course, the maximum depth of the formation projected in the direction of the breakout. This is the minimum ultimate expected objective. The inverse head and shoulders, like the head and shoulders distribution patterns, come in a number of variations, such as trendline slope and the number of shoulders, etc. As with the tops, the more complex the formation, the greater its significance. Inverse patterns, as we see here, also come in the continuation or consolidation variety, where we apply the same volume characteristic rules as we would for the reversal formation. Here we see the application of a measuring objective. An example for a downward sloping continuation inverse head and shoulders pattern is shown in this chart of Allergan. Note that volume on the breakout does expand, but not anything that looks exciting. That's probably par for the course, for rarely do we get a situation where volume explodes on the upside during a breakout. If it does, you can usually take it to the bank. Another example, this time featuring the Bovespa, is featured in this chart. It took 3 rallies to obtain the objective, as flagged by the dashed horizontal trend line. Next we see a consolidation inverse head and shoulders. Note also the head and shoulders top that was completed in early August of 1995. The objective was obtained by the initial breakout from the pattern. You can also see how objectives often turn out to be pivotal points on the chart, as the mid-December 1995 decline was halted there. The first step is to make sure that the pattern you are following is indeed a legitimate formation. For example, the price action may exhibit all of the characteristics of a head and shoulders distribution pattern like this. It may also experience another right shoulder rally in reaction, but refuses to penetrate the neckline. We've already established that until the formation is completed with a decisive break below the neckline, it's not a true pattern. This is because the neckline represents a support area, and support has not been violated. In the case of a horizontal formation, failure to penetrate the neckline also means that the series of rising peaks and troughs is still intact. This is the kind of thing which happens as those who believed it was a top are forced to cover their short positions. Since fear is a stronger motivator than greed, these bears bid up the price very aggressively. In addition, those who are still believers but are not yet long rush to correct the situation. There are several points on the chart where the probabilities of a valid signal sink below 50%, and those of an outright failure start to increase. Let's take a closer look at one of these situations. This diagram starts off with a perfectly good downside break from a head and shoulders top. The next rally is a perfectly typical development because retracements are normal. But then something unexpected happens. Instead of following through on the downside, as would be expected from a head and shoulders top, the price rises back to the neckline again. This is the first sign that things may not work out as expected. When the price once again rallies back above the neckline, the odds of a failure increase. After all, the break above the neckline signals that the rising peaks and troughs are the order of the day. The balance tips more to the bullish side when the price moves above the downtrend line, joining the head with the right shoulder. This is probably the time to cover any shorts, since the reason for going short in the first place, that is the breakdown, no longer exists. Now this is important, for the nature of the trend line will have a great deal to do with the change in the probabilities. For example, if the line is steep and has only been touched twice, it will have nowhere near as much significance when penetrated as if it was a shallow line and had been touched several times. A refresher on trendline interpretation from a basic building block module might be a good idea at this point. The next line of defense is the right shoulder. If the price can rally above this point, then in some cases it would now be experiencing a series of rising peaks and troughs if it was not doing so earlier. Finally, when it moves above the head, the pattern is cancelled beyond a reasonable doubt. If action on the long side is contemplated, it should be taken either when the price breaks above the trend line, joining the head with the right shoulder, or when it breaks above the right shoulder on heavy volume. Usually such signals offer substantial profits in a very short period of time and are well worth acting on. Again, some common sense comes into play, for if the trend line joining the head and the right shoulder is unusually steep and has been touched only twice, it would not have the authority of a more shallow one that's been touched or approached on more numerous occasions. The main thing to bear in mind is not how much money you're going to make, but what's your loss if things go wrong. For example, if it makes sense to put your stop below a good support level, such as the neckline, the line joining the head with the right shoulder and so forth, and this risk is minimal, it's a good idea to put on the trade. If not, there's always another train leaving. Failed tops are probably due to misplaced pessimism. Once the real fundamentals are perceived, not only do new buyers rush in, but also traders holding short positions in anticipation of the decline are forced to cover. Failures used to be quite rare, but now appear to be much more common. This underscores the need to wait for a decisive breakout on the downside, or on the upside in the case of a reverse head and shoulders. Failures typically develop when the indication from the pattern suggests a break in the opposite direction to the then prevailing trend. For example, an upside break in a primary bear market. Generally speaking, if you can observe a failed pattern, the very failure may be interpreted as a sign that the prevailing dominant trend is probably still in force. Inverse head and shoulders patterns can also fail, as we see from this diagram. We start off with a perfectly good breakout. As I uncover some more of the action, you can see that there's an excellent little trend line joining the head with the right shoulder. Now if that gets violated, the odds of a failure will be pretty high. This is because the line is shallow and it's been touched on several occasions. The potential joint break with the neckline is also impressive and would also greatly increase the odds of a failed pattern. As we proceed, you can see that it was violated, as was this horizontal line. My view is once the head with the right shoulder trend line has been penetrated, that's certainly enough to liquidate any longs. After all, the reason you got in, that is the breakout, is no longer in force. The price may break to the upside again, but at this point the odds do not favor such a scenario. Better to limit losses to fight another day than to go against the probabilities. Upside whipsaws are usually followed by a fairly lengthy decline, as participants who bought in anticipation of an upward breakout are flushed out when the new bearish fundamentals become more widely known. Here's an hourly chart of December silver. At this juncture, the price action is pretty impressive, as we see a nice breakout from a reverse head and shoulders. After 2 more hours of trading, the breakout is no longer in force. Before we got into the trade, we should have asked ourselves where to place the protective stop in case things went against us. In this case, it's pretty obvious, just below this trend line. What a great support area it is, since it's been touched or approached on numerous occasions. Consequently, when it was violated, it gave a great signal that the upside breakout was a whipsaw. Here's a chart for the Philadelphia Gold and Silver Share Index. It looks as if it's in the process of forming a head and shoulders top, and indeed it breaks below the neckline. As we move on, the price rallies a bit and violates this trend line, joining the head with the right shoulder. This is a strong sign that the pattern will fail. Later on we can construct this small inverse head and shoulders. I grant you this is a bit of a stretch, but so was the subsequent rally. Once again, the important point is to demonstrate the power of the whipsaw. Occasionally a head and shoulders pattern, whether inverse or regular, will be counseled by another formation. The idea is that markets reflect people in action, and people can and do change their minds. So therefore, do markets. Let's look at this example. Here's a head and shoulders top with a successful breakdown. More price action reveals a resistance level at the extended neckline. Already there's a possibility of an upside reversal with a break above this trend line. Finally, as we see more price action, it's evident that the head and shoulders top was immediately followed by the formation of an inverse pattern. When the price breaks above the 2 necklines, that's the odds-on signal that it's the bulls who are now in control. Note that the top formation had already reached its minimum downside objective, so it had already done its job. A good example of this concept is presented by Apache Corp, which broke down from a head and shoulders. In this case, the downside objective was not quite met, but note that the price immediately began the formation of a reverse head and shoulders. In this case, the accumulation pattern cancelled out the distribution pattern, and its objective was not immediately achieved, but required several runners to do so, including, would you believe, a consolidation reverse head and shoulders. Finally, this 15-minute close-only chart for Microsoft contains several head and shoulders events. First a top just here, then a decline, and a well-formed inverse pattern. Then a top that didn't work, and how about that for a rally? And the next event is another top, and finally a reverse head and shoulders. In summary, there are several clues we can look for that suggest that a pattern will fail. 1. Heavy volume on the right shoulder of a potential head and shoulders top. Light volume on a reverse head and shoulders breakout. 2. Failure of the price to follow through in the direction of the breakout following a retracement move. 3. The overall market and other stocks in the industry group failing to act in sympathy. 4. Momentum indicators at the time of the breakout are extremely oversold in the case of a top, or overbought in the case of a bottom. Momentum is covered in a subsequent module. Head and Shoulders Tops Review. 1. Price characteristics. A final rally separated by two smaller rallies at tops. 2. Volume considerations. Very heavy on the left shoulder and sometimes on the head. Low and shrinking volume on the right shoulder rally. Immaterial on the breakdown, but heavy volume is preferred. 3. Measuring implications. Distance from the top of the head to the neckline projected down at the point of breakout. 4. Signs of false breakouts. Presence of a second retracement rally and failure to break the initial breakdown low. A rally above the trend line joining the head with the right shoulder, provided it's not unduly steep. Head and Shoulder Bottoms Review. 1. Price characteristics. A final low separated by two higher lows at bottoms. 2. Volume considerations. Heavy volume on the left shoulder and sometimes the head. Low and shrinking volume on the right shoulder decline. Very high volume accompanying an upside breakout. 3. Measuring implications. The distance from the bottom of the head to the neckline projected up at the point of breakout. 4. Signs of a false breakout. Contracting volume on the breakout. Price cannot hold above the breakout for more than 2 sessions. 5. Places to unwind positions in case of a whipsaw breakout. The violation of an uptrend line joining the head with the right shoulder. A break below the right shoulder, especially if accompanied with expanding volume.